Okay, this week we had a huge smackdown. It was a maybe a bit unexpected. I thought there would be a little bit more fight in the S&P 500 at the 4,200 mark. But that's where I really want to start because the Dow Jones Industrial Average is down 9.4% from its recent highs, and that we hit back in August, and down the S&P 500's down almost 11% from its recent highs. So let's start with these markets and just kind of go through. I mean, the first thing, I had a lot of hope at the beginning that we would see the market go up, and the reason being is this head and shoulders pattern. It's a pretty clean one as head and shoulders go. I've seen a lot of different looking ones, but if we were to go from here, where the head started, up to roughly where the shoulders hit in the inverse head and shoulder, and then we were to take that and move it up, then we would see that we would have gotten up to 37 to 10, and we never reached that. Nothing even close to that. So this one failed. I know that supposedly the inverse head and shoulders has a rate of about was it 70%, maybe even 80% on inverse head and shoulders, where it kind of comes through. That the data is very suspect in almost all technical analysis from someone who worked with data most of their life. So that was, this is surprising. We're getting into ugly territory here. We get back down, I don't know, to 31, 378 or something like that. We've broken a lot of trends here. Even if we go from, say, here to here, this is when it broke, would have been around August 24th. And, now we've come down, basically tested it. I mean, we are definitely in a downtrend, and there I don't see anything that indicates, at least at this point, that it's going to turn around. And if we take, say, this high here to here, we would need to break, depending on when you do it, 33,712. With it declining like that, eventually, maybe you get some support down here. Hopefully you find some support before you get down to where the head was back in March. But yeah, it's not looking really good right now as far as the markets go. Taking a look at the S&P 500, I know a lot of people use that. I warned last week about the 200. If it broke, things could get ugly fast. And that's what happened. I mean, once it broke on Wednesday, then Thursday and Friday it came on down, and and so we continue. There's nothing good about it. You look at the weekly chart on this on the S&P, you can see how big that candle is. These last two, so it's got some momentum moving down at this point. We look at our technology plays. It broke this pattern here on last week. Had hope that maybe it would recover. That didn't happen. Really didn't even come up and retest it. Once we broke it, it's maybe a little bit there, a couple of candles, couple days that it went up, and then pretty much collapsed. And now we're trying to hold on to dear life here today. So that you know, IWM. I mean, this is even worse. Move this. We had one, two, three, four, five. We had kind of an update here, but most of it's just, it's got a lot of momentum going to the downside, and it came out, it's outside this box at the moment. Now it could recover. I usually give it at least want to see a couple days where it's below the box, closed just barely below it. So if Monday comes out and we, close below this, then we're outside the box, and that since it's been in this consolidation, it could really go down. But gotta wait for the confirmation and wait for at least one more day, and hopefully we get it. If you're a bull, you want to see that thing kick back up. And so what's causing all this? Well, it's the 10-year. It went up. We've been in this trend up since back in September, and that it continues to trend up, and we got to break this trend in order for it to come down. It's kind of faked us out a couple of times. It's struggling around here, and the hope is this would go down. That would obviously be friendly for all of the indices, for all the markets. DXY, again, it started down on Monday, and I thought, okay, here we go, we're going to break. Remember, I said about 2 days in a row. It didn't confirm. It didn't even totally get below it either. And you can probably play games with these. You could say it was up here. There's a lot of things that you could do. I put it here. I think there was other support back in here on this. So these lines are a little bit loose, but it made its way back up. Hit this line several times at 106.83. But the expectation is, the dollar's got to roll if the rates are going to stay up here. I mean, that would be the expectation. Crude oil, we broke the trend. We're kind of hanging around. We tried to get back in. We came back down. So, we tested it on Monday. Came down on Tuesday, Wednesday, Thursday, Friday, just kind of hanging in this area, consolidating potentially for the next leg down with the war in Israel and in the Ukraine. It's surprising that it's been able to hold up. At this level, you would have expected it to explode higher. People were talking about $100 oil, and that's not happening. You could imagine if we didn't have these conflicts going on, this thing might be back down here, in the at least the low 80s and probably in the 70s somewhere. The VIX has, this week really, 3, 4, 5. Here we go. We ended last week over. Let's just take a look at the weekly. We went over. We thought maybe we would crush back down. Now we were actually down a little bit for the week, so that's not bad news, because you can tell it really started to spike up there, especially I think it was today or yesterday. Let me see where some of the spikes. Oh no, it was back on Monday. I don't remember that, but anyway, we had a couple of spikes, and then it's been knocked back down a few times this week. I don't even want to look at the breadth, but at the put call ratios on their way up. We got a lot of people buying puts now. Let me just add this. I didn't put this in my notes to cover, but let's just look at the fear and greed index. Let's see what we got here. Yep, extreme fear now. We're starting to get back to this level. Thought we did get a little bit of a kick here, but not much. Certainly a downtrend here. We're back in extreme fear. To go lower, or does or we just? We'll have to see. I mean, as time, like I said, we bounced last time. Bounced. It's gone now, but in October it bounced. and it bounced in March from extreme fear. I thought we'd get a nice bounce from here. Didn't happen. Down 18, that's pretty low. And we stand at 24 today. So we get maybe a double bottom in the on the fear and greed index. I mean, it's possible. Okay, the economic calendar. Let's see. This week we had the S&P PMI. Now, everything really this week, in my opinion, everything was stronger than expected. It would be, and I think that this is what's kind of helping keep the rates up. Services were up greater than the consensus. Manufacturing was up greater than the consensus. So the markets, are showing a lot of strength, but also we've got a lot of stimulus from the government that's going to lead to more inflation later, but I'm not going to talk about that now. Wednesday, we had the 30-year mortgage was at 7.9%. We're starting to get real close to 8%. New home sales were actually up despite the rates. And basically, I'm hearing deals are coming from builders. We also had, the Powell spoke, but I never heard anything significant come out of that speech. Matter of fact, didn't really hear anything significant on any of the Fed interviews and things. The durable goods orders were another surprise. I mean, we were expecting 1.7%. It came out 4.7%. I mean, these are so out of line with what we've been seeing. I mean, durable goods, we had a blip here, but, people are still moving. And buying stuff or buying homes. And so your durable goods orders are remaining strong. Initial jobless claims, 210,000. Pending home sales came in stronger than expected, expecting it to contract. Instead, it expanded. It was just one thing after another. And even this morning, the PCE was pretty much in line. I mean, this was a little better as far as the income goes. Personal income and spending was a little bit higher, which is still shocking to me, other than the fact that everything costs more. How much does that make of that 0.5 to 0.7%? Who knows? The PCE price index, little bit hotter than expected, year over year in line. And then we had even a little bit stronger in the Michigan consumer sentiment. And so when we look to, all these things combined for, a week that was a disaster. I mean, for the, most investors. So when we look next week with Dallas Manufacturing Index, we see these numbers continue awful like they have been. I mean, there's nothing been good about it. If that comes in at 5, then who knows? Is the market, is it really that strong? Or are we just spending a lot of money from the government? Tuesday, the consumer confidence, again, harbinger of, will this come out stronger than expected? Or in line with the consensus? Are we going to continue to make the march towards 8%? Right now, I'd say we would probably stall out here by next Wednesday, but there's a few days left here. Global manufacturing PMI, it's been contracting. ISM manufacturing, it's been contracting, but some of the indications were that it was expanding when we looked at the S&P. And then the JOLTS job openings, which came in stronger than expected. These are some of the things that they're looking at they're looking in the rearview mirror, but still, this is what they're looking at. And then, importantly, the Fed interest rate decision and everything everyone is talking about right now is even the Fed when they're talking is they're going to leave things alone this time. So now they raise, then that would be another hit to the markets. Initial jobless claims we have. Keep an eye on factory orders. We got non-farm payrolls on Friday, the unemployment rate, and the ISM services PMI. Again, much stronger than what people expected it to be. So my final comments. I want to go back to the markets, and I want to add in the 200-day, because I know a lot of people are just investors, and so this line here represents the 200 simple moving average, and typically, a lot of people use this as when do I get in the market, when do I get out of the market, and go into cash, and this is often used as, once you get below, and we're below the 200 SMA, then and it's rejected. It came down below it, came back up, peeked its head out, and then reversed course. A lot of people just go to cash, at that point. But I know if you've got a broker or a financial advisor or whatever, I'd be having conversations with them, they haven't already, with you about, what are you doing? S&P 500 below the 200. The Q's barely above. It's been the strongest of those. And then the IWM way, way below the 200. So I wanted to make note of that. I think it's important to kind of have something that, when are you in, when are you out? We seem to have, this thing's going to start turning down too with the last few days, last 3 weeks, 4 weeks, with this break of the 200 here, and then nothing to make it up. Got a little head and shoulder here too, don't we? Let's just take a look and real quick and just see something like this. This isn't majorly scientific, but if we go down here, where are we? A little crooked. Yeah, roughly. We're even beyond what typically the head and shoulders pattern is usually the length from the shoulder to the head, and we've gone now beyond that. So that's this week. It was unexpected from a standpoint of didn't expect this much weakness. We knew all these things were going on with Israel. You could have seen gold today just ratchet up. It's back over 2,000, I believe. It may have closed. Well, there's still a little bit more time before it closes, but it really shot up when Israel went into Gaza and started their military operations. Anyway, that's what I wanted to cover this week, and remember, there is always a better way.